Good morning. I am Will Ripley and I lead GAWS of London's Marine and Cargo practice. We at GAWS Marine are very fortunate to have many great relationships with recognised key markets in London. And I'm very lucky to be joined by some today who have kindly given up their time to share their thoughts on the current state of the cargo market in London and their thinking on what 2022 may have in store. By way of an introduction, I'm delighted to introduce my panellists today. Maughan, Head of Cargo and Specie at Navium Marine Limited. Bryan, Deputy Marine Cargo Underwriter at Tokio Marine HCC. And Chris Hicks, Underwriting Manager, Marine and Cargo, UK and Europe at Liberty Specialty Markets. We were also due to have Chris McGill, who heads Ascot's Marine and Cargo team, but poor Chris tested positive for COVID-19 this morning and therefore can't join us today. So we send our best wishes to him for a speedy recovery. For those watching after the event, we're speaking at a fairly pertinent time for the market in light of recent events, with the heartbreaking Kentucky tornadoes last week and the COVID booster rollout all occurring very recently, having a significant ramifications within the cargo insurance market. I also appreciate with year end and these significant events, my panelists are particularly busy, so I promise them not to take all their morning and get things going now. So if I may, I will start with you, Mr. Maughan, on our first question. The past couple of years have been challenging for cargo insurers. Where does the cargo market find itself today? Henry, please.
Yeah, thanks, Will. Obviously very pleased to be here and always very pleased to talk a little bit about the cargo market and how we see it over here in our sphere in London. The market, I mean, we spoke last year about this on this same forum, and I'd like to say that the 12 months since we last spoke, I think the word I would say is stabilizing. I don't think we're in the same position we were in early 2020, where there was a real capacity crunch and brokers and clients were struggling to find 100% support for a lot of their risks. And I don't think that was a good position to be in for anybody. And yes, it resulted in price rises and necessary price rises on a lot of business for the cargo insurers. But actually, what we need is to be able to find solutions for our clients. And if they can't get to 100% capacity, then that's actually not a good result for anybody. So I'd say that there has been a stabilizing effect in the last 12 months. And with some of the price rises and up until last week, a slightly more benign large loss environment, there has been new entrants into the market, Navium being one of them. So people are taking advantage of a slightly better pricing environment. But I would say there's still work to be done there. There are areas of the portfolio which are getting to rating adequacy. There are still areas that will need to be looked at for price changing price rises. So one thing that I think brokers are definitely finding is that it is easier to get support to well-led and well-priced slips now. So that does mean that there is a slight stability in some of the pricing. So the double-digit rate rises we saw for 2 or 3 years, I would say those are now few and far between, except on the most distressed business. So if you've got a good risk profile and a strong loss record and a good broker behind you, you should be able to get relatively stable pricing in this market, which I think is good news for everybody. And one of the benefits we've been able to do as a market in the last 24 months has been to correct some of the wordings that were around in the soft market. So there has been improvements on that side, which again helps us to be able to tell our management that we know where the losses are going to be coming from and what we're covering, rather than the kind of the grey areas that we're slipping into wordings, which were really hurting our attrition rates in the market. So yeah, I think stability was the word that I was kind of going to say, or stabilizing. We're not 100% there yet, but we want to make sure that we're not, we don't creep back into a soft environment too quickly, especially with things like the events in Kentucky, where we know that large losses are still very, very much a possibility in our portfolios.
Chris, I appreciate you have slight working from home challenges today, like all of us, and sort of manning the fort with the children, so going on and off screen. So look, thank you. I'll come to you sharply now whilst we have you on the next question, if I may. And that is, the market seems to, and we've just discussed it briefly now about rating adequacy. The market's moved discussion from rate rise to rating adequacy on accounts, it appears. very simply, please, and I had this question last week on a panel search for my explanation as well. What do we mean by rating adequacy? What does the market mean by that?
You know what, it's a difficult one, because it's not necessarily a simple answer to what rate adequacy means. I think rate adequacy means different things to different insurers. So if I had to essentially think what it is the price point for an individual account that an insurer needs to hit to be able to hit their long-term returns to their capital provider. But it's a function of lots of different things. So one, the return horizon for different insurers is very different. So different capital providers have different kind of demands of what return on equity they expect. But it's also influenced by kind of the underwriter's data, the underwriter's own modeling, in terms of the underwriter's own loss patterns. So Jack and I, or Henry and I, might have a very different data set that we work from. We might view the same account with a very different lens, and that could be because if it's a steel account, these guys might have very good loss experience on steel accounts. I might have very bad loss experience on steel accounts. So rate adequacy is very different for each insurer. And it means you as a broker have to pick very carefully the markets that you partner with and finding the right carrier for the right risk. I'm going to think back to kind of what was said in the first question by Jack and Henry, because I think it's quite interesting actually around rate adequacy and where the market is. I think we are. The piece to remember is the last 3 years have been very bruising, both for brokers, for insurers, and for the clients themselves. But the rate rises that have occurred have come from kind of a historic low point in the market. I mean, I started in 2007, and my entire career up to 2019 was reduction after reduction after reduction. And the market had been so hollowed out, there was not many insurers who were making money. Now, where do we find the market now? I think some insurers are starting to approach rate adequacy. It very much depends on kind of the industry sector, but there's some important things to take into account. The pandemic's actually been quite interesting in terms of how it's changed loss patterns. And what we're seeing in our data is certainly a depression of kind of the attritional loss patterns that were out there. And I think you can kind of anecdotally explain that around things like lockdowns, where maybe there was less cars on the road, so subsequently there were less RTAs, or there might have been less truck holdups or robberies because it was harder for criminals to gather when there were lockdowns in place. We're now starting to see those attritional loss patterns come back and the impact on people's rate adequacy, what that means. But the big kind of question that you've hit in your intro is the devastating events at the weekend in the center of the United States with the tornadoes. It's completely out of season. It's a large loss event. And these losses are still out there. And it's been a year full of kind of non-core cat events. So Germany floods at the start of the year, Southern European wildfires, Chinese flooding, Hurricane Ida. There's been a series of significant cats along with the man-made losses. So Durban SRCC losses that have hit the market, theft in the United Kingdom, warehouse fires in Japan. So while the market has seen substantial rate rises, this surge for rate adequacy is still, ongoing. But, it echoes some of what Henry and Jack say. I think there still is upward momentum because I still think the market pricing needs it. But it very much varies by accounts, and there are some accounts and industry sectors that are approaching rate adequacy, and you'll find much more stable renewal terms there. But there's still pockets of the portfolio, where maybe the exposure is very tough to insure, or they're very distressed accounts where we're still seeing significant rate rises.
Chris, thank you. You answered that far more eloquently than I did last week, so much appreciated. I think you just touched on it briefly there, and it's one of the things we talk about rate adequacy. You've then talked about the rate momentum on certain accounts. One of the things I'm quite keen to sort of establish and understand from your guys' perspective, and Jack, I'll come to you if I may, please. But in light of the conversation around rating adequacy, how can clients, and we like to think we partner up with some decent clients, differentiate themselves from decent capex and what they do, how can they continue to present their risk in the best possible light and differentiate themselves from their peers and get the benefits of those lower rate rises or stable flats, whatever?
Yeah, so Chris was touching on a lot of points around rating adequacy, and I completely agree. I think we're in a period of potential recalibration of what our books look like and the profile of people's portfolios and different events affecting different type of books. But I think another key thing to consider with regards to adequacy, it's not just all about rate. There's also the appetite. So the first thing an underwriter looks at before they're going to accept a risk, it's not the rate, right? It's the risk quality. So that really is down. And this is where the client has a lot of control, and partnering with the broker to present their risk in the best light. And there's a lot of industry sectors that are potentially misunderstood, or there's a bit more of a blasé kind of red mark against their name. If you was just to name a few, say like pharma, target goods, timber, lumber, a lot of that there's from bad experiences or just a market view. But actually there's some probably really good best-in-class operators within those industry sectors, which I believe will have a different advocacy need to the kind of overall assumption of some of those other clients in those industry sectors. So look, it's really important to be able to demonstrate why maybe you are best in class, better than your peers. And I think it's really important to remember as well that us as insurers, we don't know it all. We still love to learn. We love learning about your businesses. We love learning about your industry sectors. It helps us make better decisions across the piece in our portfolio over our whole careers, which can kind of change our viewpoint. So, whether it be a direct meeting with that client, it's always good face-to-face. And the COVID situation, home working obviously has kind of crippled that ability to have the travel and meet and greet. But there's ways to adapt and adjust to that. So things like this is great. The Zoom calls, we've actually been able to meet some of our clients more often than we would have when we traveled once or twice a year. So that keeps us in touch more. And then actually the people that you're getting in touch with, it's quite interesting to know who wants to partner with you, who wants to share their news more frequently. And that gives you a sense of comfort as a carrier, as an insurer. And that comfort factor really does influence, I believe, the terms and conditions that you can get in the market, rather than being kind of given a generic market price, because it's a generic market view on an industry sector. So yeah, good presentation, good contact point through broker and underwriters. Share the things that you do differently. Share the things that you, in my opinion, what you need. What are your, as an assured, what are your key criteria for this insurance? What are your insurance needs? Because actually we can hone in and really focus on those points and put a lot of the other wishy-washy bits aside that sometimes are the banana skins that we trip up on as carriers. And Chris was speaking about attrition creeping into the book again and different dynamics in the economy, but we can avoid a lot of that, and we could probably trim down coverage to make pricing better, but you've still got your essentials or the priorities that you need the insurance to covered at a good adequate price. So let us know what those are. I remember sitting in a client on a site visit at a very large pharmaceutical distributor in the US, and this is quite topical and timely, but we asked the direct question: what is your biggest fear to your business and balance sheets? And this is a farmer account. We thought power outage or temperature variation to the goods, contamination to the product. And we were sitting in Tennessee, and he said tornado. And this was about 5 years ago, before some of the larger tornadoes that had hit some specific London accounts and caused some material monetary kind of impact to our P&Ls. But I don't think many people in that room truly considered tornado being a real concern. But the client, it was the thing that kept him up all night. And he said, that's why I buy this coverage. I don't care for anything else. I can cover that. I've got deep enough pockets or different, risk exchanges to deal with, but I can't cover the total loss that a tornado could cause me. And actually that forced people to kind of ask further questions about that peril, and then get a comfort level around that peril, price that peril accordingly, and the client continues to have that coverage to this date. And you could argue now more so than ever needed, but it's always been a peril there. The client's always known that. So yeah, I think that kind of communication and direct communication, to the point communication is critical. And I think that can ultimately improve terms and conditions you get that might meet a different adequacy level to what is deemed a generic pricing.
Perfect. No, Jack, appreciate it. Thank you. And us brokers are very happy to continue to educate you and teach you things. So that's not a problem as well, as you touched on. And I think actually to add to your point, something that Chris has always said, and I think mentioned last year in this conversation, just that open info sharing dialogue, just being open to questions and carrying on and lead on questions. That's massive. And like, hopefully I like to think clients are, our book, clients we deal with are open to that and that dialogue and sort of learning and understanding each other, that it's an encouraging questions as opposed to sort of closing them off and actually learning, building together. So Jack, thank you. Every news outlet is discussing the challenges that global supply chains are facing. In light of COVID-19 and issues such as Brexit that are putting strain on supply chains, does a stock throughput effectively cover an insured supply chain exposure, and does it need to evolve as the world moves? Henry, please.
Thank you for that. The simple answer is that it sort of depends on what coverage you've got in your stock throughput, but the concept of the stock throughput should be able to cover your goods from what we always say is, cradle to grave, and all the processes that go through that, and the stock locations that go from when you start manufacturing something to when it finally ends up at its final destination. So with the carnage that has been the world freight market in the last 2 years since COVID, with vessels being in the wrong place, containers being in the wrong place, we've had container ships getting stuck in the Suez. We've got dozens of ships sitting outside ports in America and Asia waiting to get in and unload. It really has been a challenging environment for our clients to deal with. And on top of that, the shipping lines have taken advantage slightly and are charging through the nose for freight rates. So it is costing a lot of money. It's something we have to bear in mind as well when a loss comes in, that cost insurance and freight. The freight part of it is actually getting quite expensive. So it's going to take some time as well to unravel. And I don't think people realise this when the pandemic hit early in 2020, just how much of an impact it was going to have on factories stopping in some parts of the world, people needing things in other parts of the world, and we took for granted how seamlessly it seemed the global trade kind of worked pre-pandemic. So that's been an eye-opener, and it's finally got itself onto the news and into newspapers, which, as you say, people are now aware of it. But from a cargo stock throughput perspective, we've got to be wary that we're covering the right things. We are physical loss or damage insurance. So we are on. Predominantly, we should be here to cover that. So things like business interruption is not something that traditionally you'll find in a cargo stock throughput. Delay is traditionally excluded, but actually we've got to make sure that we're entrepreneurial enough to be able to offer some kind of solutions to our clients. But in the past, again in that soft market time that Chris mentioned, from sort of 2007 onwards to up to 2018-19. A lot of these wordings were widened to sort of cover slightly quasi-BI, and we didn't really have the power to control that as insurers. We were just sort of lumped a little bit in our wordings with these clauses, which cause those attrition and actually sometimes some very large losses to creep in where they probably shouldn't have been. But that doesn't mean we can't cover these things with the right sublimits, the right pricing, and the right clauses there. So it's something we need to make sure we are adapting as a market to the current needs of our client base. We can't just turn around and say, sorry, that's excluded, because actually our clients sit there and go, well, that's something that I need to be addressed. Where am I going to find it? So it's something that we do need to, as a group of insurers, both in London and globally, we need to think, right, if the world is changing on this and there are needs out there, what can we offer legitimately to our clients without getting thousands of losses come in the first day we offer it, if we can do it in a controlled manner and charge for it accordingly, so that it's something that we can actually offer to clients. I think that's something we should be looking at. We're always open to trying to be as entrepreneurial as possible. It takes a bit of time to understand these risks, and again, it's more questions and more information that's required. But there should be some solutions that go slightly past just the pure physical loss or damage, if it's done in the right way.
I think I suppose that ties into the point we've just made, that clients need to differentiate themselves, have that open dialogue, understand what those extra exposures are needed, where their pressure points are, where the concerns are. And to your point as well, just making sure you guys sort of ag it to an extent. You aren't just open for unlimited losses coming in on these extra additional perils. Chris, I see you unmuted.
I did. I was just going to add, well, I think on the physical loss or damage side, the market's actually been quite flexible and responsive to certain trends that we're seeing. We've seen a big trend of assured pitch is in much more vertical coverage on their transit limits, and either doing that on a stop throughput program or maybe looking for a standalone excess cargo policy. And the reasons they're doing that is to secure space or to secure freight rates, to get lower economies of scale on the freight rates. So the market is stepping up into those places where there was never products needed before for access transit, but we're seeing a lot of that business come in. So we've been very responsive to that. Also think there's lots of clauses on a standard stock throughput policy, like accumulation clauses that kind of help an assured where they have got an unknown accumulation. So it kind of gives them the flexibility to have an increased transit limit. Duration of coverage clauses that mean, even if the goods are unloaded but they can't clear customs, our policies aren't terminating and just leaving somebody there with no coverage. The form is showing good flexibility on that physical loss or damage space, which whether that's everything an assured needs at the moment is questionable, but certainly from a physical loss perspective, I think we're responding very, very well.
Yeah,
thank you. I think just to add on that as well is that the vertical nature of some of these shipments for the clients to kind of navigate through this supply chain situation at the moment is that, putting the underwriter hat on here is that that changes our risk profile again, right? So what we need to communicate back to the client via the broker is that actually that transit rate that you had on your primary stock throughput, if you're now going that vertical on a transit, or sometimes on excess layers and now having transits exposed to it, I'm talking hundreds of millions, whether clients are chartering their own vessels or just putting lots more boxes on to make sure they get there. The GA contribution for that is completely different to what the smaller attritional transit part of a stock throughput kind of contributed to as a whole package. So again, that profile of that risk has changed, the volatility has increased, the potential loss has gone up, and that will demand some more rates. But the good news is that going back to the capacity in the market, there is more there. And we have been able to meet the demands of the clients and been able to offer those higher stretches and the accumulation clauses that Chris mentioned. People are still comfortable; they're working within their limits. But it would be a scary number if everybody was to calculate what they've got on a normal limit, double it up, all sitting in Long Beach because it's not moving. I think it's a thought to have in the back of your mind.
That's what we're about, so that's fine. People give you those sleepless nights. No, gents, thank you. Appreciate that. There's been significant movement in both personnel and new capacity within the cargo market in London, and this doesn't seem to be abating. How will this affect the market going forward?
So yeah, it's been a really interesting 12 months. Speaking from my personal position, I moved from Hiscox to Tokio Marine HCC and started practically in the new year at 1/1. And the market was in, I would say, a hangover stage of 2020. So their brokers and clients were struggling to get placements completed. In that time, we knew that there was new capacity that was in the wings, ready to come on board, just waiting for finalisation, reinsurances. So from about 1/4 onwards and 1/6, there's been, like you say, a continuous amount of new capacity, and I've seen personally a shift in whether it be business flow, ease of getting onto new business, sign-in pressures. And Chris would have seen, this even more so being an existing market carrier for many years. So currently, the business flow is still high. It feels like there's a lot of business coming across from America, where the kind of volatile nature of US carriers have kind of been a bit knee jerk, and they followed London, and now they go lower, but then they take the losses, and then they go double in London. So I think London tries to offer that stability, even with new capacity. And if you use this panel in particular, Henry and I, we've both been in the market for many years at previous shops. So we've probably been on many placements before, worked with the clients, met the clients, worked with the brokers, understood the risk. So we kind of remember where the risk was before its pricing, what its kind of key points are on the risk, where its adequacy needs to be, what its loss record's been like. So I don't think there's an influx of new capacity being like overly or super opportunistic and saying like, let's make hay whilst the sun shines. I think there's been more of a kind of a cautious approach on, we need to get this right because the market's been burnt so bad in the past. We're here to add a little bit more of competition and capacity, which is healthy. I haven't yet seen anything kind of, I don't know what the right word would be, not reckless, but kind of left field from what the market has been trying to achieve with their momentum. So I'm hoping that it will continue in that way, and people will do, everyone's got to do what's right for them, and everyone's got different agendas, different balance sheets, different portfolios. So it's very hard to be able to say what the market should do. Everyone can only do what they think's right. But if you look at the market and the kind of risks that are coming to our market now, it is the high cap, the high volatility, the big limit stretches, which is great. That's Lloyd's business. Look, that's what Lloyd's has been here for and will be here to do. And that's where subscription kind of, I would say, doesn't let people kind of run away on their own because they can't. You can kind of put some numbers out there that might look really attractive, but the broker and the client still need to get that risk 100% supported. And I think there's still enough people who are still hurting, haven't made money yet since the surgery of the past years, to be able to follow anything that's too kind of competitive. So I'd like to think that going into next year, I don't know of any other new capacity entering. So we may be at a point of stability. We've used that word quite a bit, but it might be a bit more of the same of this year, and it might start to flatten out.
As you keep on mentioning it, all of you, actually, I'm going to hold you all to it next year as well, that stability line. So yeah, you're bang to rights now, ultimately. Jack, thank you. Of the significant new capacity entering the London market this year, a large portion of those carriers have entered the market without a Lloyd's vehicle. What are the advantages of this, and what are your plans going forward, please, Mr. Maughan?
Yeah, it's an interesting one. I mean, I've always been I was a Lloyd's broker to start with, and then was a Lloyd's underwriter for the vast majority of my career. And an opportunity arose to leave the Lloyd's arena. And so far it's been eye-opening in many ways at the flexibility that is afforded to you when you do leave Lloyd's. Obviously, Lloyd's has its huge benefits with the central fund and especially in the States the reputation of the claims process and all that goes with it, and also the licensing, and that's something that we are dealing with ourselves, and is actually from our perspective, that the flexible nature of the reduced reporting levels. I think that's one thing that Lloyd's has definitely increased in the last few years. Past with the Decile 10 process for cargo and other lines in 2018 and onwards. I think the pressure on underwriters to report on exactly what they're doing on a day-to-day basis has increased, and I knew at my last shop that was taking up more and more of my time. Whereas now we're being tasked with underwriting, and actually I'm able to focus on actually assessing risks, which is what we're here to do, and building a sustainable portfolio. And again, there's the benefits of what we've particularly got at Navium is we've got our capacity providers are giving us a 5-year binder, which again is huge benefit for us. Other MGAs don't enjoy that kind of flexibility, so it just means we can build something a lot more sustainable and long term. We don't need to be continually looking over our shoulders to get capacity again at the end of every year. So that's something that's given us a huge amount of heart. And yeah, I think for us that going forward, it's trying to offer things that might not fit in Lloyd's. Clients are going to want that security potentially of the big Lloyd's central fund, but there are a lot of other options now available, and also Lloyd's isn't without its problems. We've seen that with companies walking away from the Lloyd's project and saying actually we might be better off on our own company paper. So it's got some issues to sort out on that, but we're here as a viable option going forward, and hopefully that project will work for us.
Very top man, thank you. I appreciate this is over Zoom, so we can't get too proddy in the room together. So I'm going to counter that and come to Mr. Hicks, if I may, and ask you to sort of talk to me in the current market cycle. What are the advantages of being an established syndicate and recognised leader? Please, Chris.
Thanks, Will. I think there are probably three key advantages. So I'll go through maybe ascending order of importance. So data is the first one. So being an established carrier means, we've got years and years worth of data, and that informs things like rate adequacy. It also means that the pricing, I think, that we're able to put out is far more closely aligned to the cost of risk that an account brings to our portfolio. The second is scale and duration of capital. So we are we're a mutual, but we're also got very long-term capital with us. And what that means for an assured is that when you buy for us, we're able to take a view of a risk that, our time horizon is much, much longer. So we're able to look at something and say, well, is this a good account? Does it hit our risk selection criteria? And then how can we put a competitive deal, looking at kind of the long term and how we can partner up with them? I think this market has really shown the advantage of that. There's no doubt for me that clients who have bought long-term with their carriers and have really made an effort to kind of build relationships with them, all that stuff that Jack said earlier about kind of opening up their business to their insurers and kind of being very open and honest about what they need. They've had much better pricing experience and a much smoother experience of buying their insurance. But I think, the bit that gives me some pause with some of the new capacity that's coming in, I'm not saying it's anyone on this call, but the ability to service claims is one of the most important things that brokers and clients should be looking for. They should be looking they should be looking for experienced underwriting, so people who are able to take a view of broad swath of the market and put very relevant pricing up. It's very kind of both competitive but also supportable, and it's not going to be volatile. But then making sure that the capacity provider has really good claim service, because when claims happen, you need someone who's going to be able to step in and really help your business recover, get claims paid very, very quickly, even when they're very complex. That's the main thing that, as an insurance buyer, you need to make sure it's out there. And I think that really differentiates carriers, both new and established, for the people who've got that claim service and that value add. And it might not just be claims, it might be value add from risk engineering or survey warranties or things that you can bring to the insurer, maybe even just insights and data, but things that you can bring to insurer to help make their business better.
Super. No, thank you. I think that's the reality, isn't it? We are here to pay claims, ultimately. That's our job. That's the nature of the job. So when it happens, we want to do that as swiftly and easy as possible to get our clients the peace of mind and keep that longevity. So, no, Chris, much appreciated. Thank you. Jack, for you, sir, please, and I appreciate this, probably pertinent to what you guys are doing. Has the London market re-established itself to write SME mid-market business competitively?
Yeah, I think there's been a fresh approach to it in the last 12 months. I think if we was to use some of the conversation points from that last question around Lloyd's and a lot of the work done on the Decile 10, and a lot of senior management had a requirement for minimum kind of price for capacity, and a lot of that small SME business fell off that kind of checklist of meeting the limit you was giving out, because there's sometimes a successful business does need a $30 million or $20 million limit with inventory. So but sometimes the price for that rate online wouldn't have been purchased by the client. So a lot of that business fell by the wayside, and a lot of carriers let it go, really, because it ticked a box to meet some of the Lloyd's reporting requirements and senior management surgery of the book. So there were some players who remained present in that space, and I think they benefited from doing so. And I think the main reason why people like it is because it offers a little bit of kind of non-correlating volatility to their books. If we're doing big, large, complex Lloyd's capacity-driven subscription business, some of that SME can really lay some really nice foundations. There's some really good clients out there running some really smart businesses with really good track records, really good operations. So if you go back to what we were saying again about appetite and adequacy of a client, there's no reason why you wouldn't accept that client just because it hasn't got a lot of digits on the premium slip. So I think people are now re-engaging with that sector because they see it as a profitable sector. The challenge with it is the volume, and it's a bit of a critical mass thing. So you have to scale up and you have to be able to get through the volume. But I think that where the market went wrong, and maybe some people lost money on that business or it didn't make sense, was that they didn't spend the right amount of time and look at the right things like they would on a complex risk. But ultimately, it may still be a risk with $20 million sitting in Tier 1 Florida. It still has that same cat footprint. It still has the same impact on your P&L and capital as a 20 million location as part of a 100 million TIV portfolio of a larger risk that pays X amount. And sometimes people were just kind of being quite blasé and just trying to get the volume in and losing track of whether it be aggregation, risk quality. So I think a way of what we're trying to do, we've created a mini consortium as a sidecar to try and access some of that business, but do it efficiently. But like I say, not dropping the ball on the risk quality and acceptance is data. And Chris just mentioned data sets. We're trying to build that up for this SME business now, because we don't feel like it had that enough attention with regards to data capture. But actually, the more data you capture on that, you can probably make some pretty quick decisions. So yeah, we're going through a tech approach to get the submissions through, and the tech will do some heavy lifting on a lot of what we say the KPIs of what the main kind of things we think are risk critical, whether it be sprinkler location, the zip code and the cat footprint, construction type, all of the basic COPE information that we ask for. But whether people look at it on a 20-row SME business, our data will do it, our tech will do it very quickly and do a lot of heavy lifting. So technology, data, everyone's got a bit more access to it now. So I think that industry sector becomes a bit more accessible if you invest into the tech. And I think the other reason why people are looking at it is because there's so much about it, is because of the collapse of the line slips and binders in the market. And again, that does come down to the control and efforts of Lloyd's to get on top of performance in the cargo market. And those sectors, the way that SME business was bundled together, became quite toxic. People lost control. Risk quality wasn't assessed. Pricing was underpriced. Commissions were too high for the workload that it required, and the margin was completely eroded. So that was, and under some of these line slips, there may be 100 to 300 accounts, and they are all clients who need coverage. So we want to give them cover, but we need to do it in a adequate way that we can make margin and money on. So that business is floating around. It's now, how do you capture it in a smart way? So I think, there's a lot more re-engagement, and I think there are a lot more solutions for those clients who may have felt a real tough ride in the last 12 months, where their vehicle that they were placed under no longer existed or fell apart. That there are now options. So I would say London is an option for SME business. It isn't just there for the big complex cat stuff. So this would be a message to say to the US and the rest of the world, like, London is open to see that business, and we feel like we've got the tools now at our disposal to manage it and control it in a better way than we ever did before.
Jack, perfect, thank you. And it's just a slight follow-up question to that, and to anyone here ultimately. I think at my old shop, remember sort of touring certain countries in South America or different tours in the States, and talking about stock throughput and the benefits, and how we are maybe half the rate of the property guys at times. We rate stock very cheaply. And evidently we've had some significant losses, some big fires, tornadoes going through, etc. Last couple of years with Lloyd's, the focus has had on decile 10, the way the market was. Is that an area we think that's where we're more educated on as a cargo market, and underwriters in particular, that focus on the property stock exposure?
I would say if you're a cargo underwriter covering stock, you have to underwrite it like a DNF underwriter. That's there was a lot of very sloppy underwriting that was going on, some of the stock exposures, and I think in the last 3 years, cargo as a market has got far better at kind of digesting information, be that kind of things like flood zone information, looking beyond tier 1 cat perils, but also looking at the risk quality. There's been a real focus on kind of the provision of information, be that COPE information from maybe the SME business, but also reports and kind of undertaking detailed analysis of certain reports to make sure that the risk is being priced appropriately.
Perfect. No, thank you. Yeah, I think that's something we're sort of relaying those last couple of years, the change in just information sharing, particularly on stock, that side of things is totally different, and as it should be. We want to keep some longevity to it. So thank you. Gents, appreciate it's getting late in the day. So I've got one final question, and I'll come to you all on this, if I may, please, with your crystal balls. You can be as brief as you like, but I would like all of your predictions and outlooks for 2022, please. I appreciate it's a tough time to answer, having what's occurred in the last week or so, but give me a little thought. I'm going to start with you, please, again, Chris.
I'm not going to use the word stability, Will, because you said you'd
I'm holding.
Don't do it. Don't say it.
Written it down originally.
Production. Use that.
There's no doubt, coming back to what Henry said, the market is in a better position than it was, in a different position than it was in kind of going into January 2020 and 2021. But everything needs to tie back to rate adequacy, right? There is this pattern of kind of the attritional loss rate is returning post-pandemic, and I don't know what impact the recent round of lockdowns will have on that. There has been this space of significant risk losses and kind of significant non-core cat events that I mentioned earlier on. There is the impact of climate change that seems to be, impacting kind of our policies year on year, where we have floods in areas that weren't flood zones anymore. We have wildfires where, we have wildfire seasons where there was wildfires every couple of years in the past. I'm not saying there's not any capacity in the market, but the capacity is limited in terms of what it can do. Something that Jack said about, can the capacity lead business, and, it is still a subscription market. So the impact of that is blunted somewhat. But it is a more stable place, but I still think there's upward momentum because there's still people looking for rate adequacy. And there's still subsectors of the portfolio that are still very, very distressed. The key message from me, though, would be coming back to that risk selection piece. Good assureds who manage to differentiate themselves and are open about their business and what they want, there'll always be good deals on the table for them and flexibility of carriers, and people will always want to service and retain those accounts. So that would be my message. That it is more stable, and for good assureds, there's conversations to be had.
Perfect. Jack, Henry, slightly less on the fence from you two, please.
Yeah, well, I'd echo the risk quality and the retention that will follow through from the information flow and the client contact. So yeah, that will be the thing. If the price goes down or up, like the core people know who their core book is, and they know what they'll do to look after that. So those conversations we had. I think there's a few unknowns. COVID-19. It seems like we're going through a little difficult patch through another winter with variants. So does that keep the supply chain kind of issues going throughout the world? Will there be more losses that come through onto the cargo world for a PD side of things? Yet to see. There's reinsurance markets in 1.1 and 1.4 that can dictate things. Subject to no more market coming on board. I think the cargo market in London it's healthy enough now with options for brokers. So like Chris said, the world is a forever changing place, and I genuinely think it's actually too. I don't think any crystal ball will be able to know what tomorrow brings. So what we don't want to be is a fickle, volatile market. That is one thing that we have really tried to honour and really tried to, in the tough times in the last 2-3 years where we've been having to sell price, it's for good reason. It's not for the sake of it or because we could, because others were. It's because everybody needed to, because the capital was being eroded. There was no margin. We have to adapt with the world, and if profiles of clients change, limits change, nat cat perils, footprint change, we have to change too. So it's very hard to say that this is what a rate looks like today, because tomorrow could be very different. But we will try to be as consistent. That would be my parting word: consistent, and that's in message, approach, underwriting, and pricing, and reason.
Perfect. Consistent stability. Perfect. Thank you, Jack. Henry.
Well, I can't add much to those two eloquent answers, but I did want to just make one point, which could be an area that could challenge the market next year would be around, how loyal the clients are to their existing brokers and carriers, and whether they get their heads turned by brokers coming in and saying, I can beat that price for you. And obviously every assured will want the most competitive option on the table, but they need to know that it's not always just about price. It's also about, going back to what Chris said about claim service. It's about making sure you've got a consistent panel that will be there in 5-10 years, not just someone who's coming in to make a quick buck. And that's one of the areas that was a real area of concern in the soft market, was clients taking advantage of cheaper deals year on year and actually losing that loyalty, losing the traction they had with carriers. And it's something that I don't think helps anybody. So the open and honest discussions that you can have with your carriers and brokers only really works if you're looking to have a long-term partnership with them. If you want to pick up the phone to another broker every year, it does make it harder for us here in London to know exactly where we stand with those clients. So that's something that is definitely a concern for carriers here in London, is that brokers picking up BORs or tendering every year is something that is an added challenge to us. It's obviously competition, and healthy competition is necessary, but it needs to be done in a controlled way, and it can assist the dislocation of the market if we feel that every single year our clients are going to move brokers. It doesn't help. So again, it's something that I know that your clients are extremely loyal because the service you give them will, but for other areas of the market, it's something that we do look at.
Henry, thank you, well put, and I'd echo that absolutely. So no, much appreciated. Gents, noting that I promised I wouldn't take all your mornings, I'm running slightly later, so look, I'm going to wrap it up there. But I'm enormously thankful for all of your insight, and I've no doubt those listening will find it of huge interest and value. We at GAWS have a very close relationship with our clients and our retail partners, and it's hugely important to us to have the opportunity to share with them directly from the horse's mouth how the market views current issues. So thank you. I've no doubt those listening have found this of value. If you have any further questions on today or would like a fuller conversation on cargo or stock throughput insurance, please don't hesitate to reach out to myself or the rest of the GAWS team, and we'd be delighted to help. But for now, I leave you with best wishes and thanks to those on the call today, and all of our clients and friends who've entrusted us to work with them over 2021. From me and us at GAWS, we wish you and your families a very Merry Christmas and a wonderful 2022. Be well.
Thanks, Will.